Hi, Chris.
Hi, Ron.
Why don't we do another form of testing today? We were working with relative strength in the last movie, but let's go ahead and work with some chart scripts, and let's work with one in particular. It's a indicator, or a couple of indicators developed by my partner Ian Woodward, and let's see how they work out, and we'll test them against some ETFs. Why don't we just use the standard Connor's ETFs, the 20 that are in his book?
Okay, sounds...
The book, High Probability ETF Trading. Sorry.
Yep, no, that's good. And so first of all, I've already set this chart up so that you can see the EM% buy and the sell. So the buy is the one above, and then the sell is below here. So every time you get one of these signals, you can see them on the chart, which is quite handy. But of course...
That's good.
Yeah, we'll go through and run it on the entry and exits over the Connors ETFs. So the Connors ETFs are already set up in here. And these are actually system scans that come in version 4. And so if you look down in the system scans area, we can just drag them on here.
Okay, good. Now, is your date set up properly? I see you're filtering the dates.
Ah, right, yes, because my snapshot goes for 10 years, and I've filtered it down to be from October of '07, which was the peak of the market when it was rallying for all those years. And so we're looking from that market period until yesterday, which was the 9th of June. So incorporates a down market and a bit of an up market too.
Okay.
Okay, let's run the buy side. We'll get our signals for the buys. We'll put the sell side in, and we'll get our signals for the sell. And then we'll just hop over to the trade simulation, and we'll run it using the sell signals rather than fixed hold period. Here's our list of trades.
That was fast.
The system has been optimized for speed. There's one of the main design goals was to get it as fast as it could possibly be. So here's the daily equity over that period of time, and the red line that I just added here is superimposition of the SPY, which is the ETF for the S&P 500. So yeah, you can see how our strategy equity changed. That's the gold line, and how it in the down market it also was losing money in the down market, but it was nowhere near as steep a loss as the actual S&P 500. And then what's interesting about this particular buy and sell rule is when we get to the March 2009 low, both the SPY bottoms out and the strategy bottoms out too, but then the strategy recovers much quicker than the S&P 500, and in fact the strategy is over this time period profitable, whereas the S&P 500 is still underwater after all that time.
I see that. That's good.
Useful to know. Now we could look at some individual trades if we wanted to go into see, maybe the biggest loser, if you're interested in that, biggest winner.
Okay, sure. So what's the biggest winner? EEM?
EEM is the biggest winner. It was a $555 winner, and we can see the trade here. The entry is listed down here, so you'll see the blue signal in the buy area of the chart, and that signal fired on Wednesday, March the 4th, 2009. The following morning, the simulator bought that ETF and then held it until we got a sell signal, and the sell signal occurred down here on June 15th, 2009. And so the following morning, the simulator sold that ETF and made that gain.
So there wasn't a sell signal during the middle there when it looks like you could have been shaken out. So it held you through that period in late April, early May. That's good.
Yeah, that's That's a good one. We should look at the one that was the worst as well, and
Okay, let's do that.
see how that worked out. So I can just sort them, do a reverse sort, and then the top of the list, the worst loser was XHB, and that is, I believe, the home builders.
Well, let's take a look. It shows up in the chart, doesn't it? There you go.
Yeah, right here, XHB home builders. So yeah, we see the entry here was actually at January the 2nd. Well, the signal was January the 2nd. The simulator is set up to buy the next day at the open, and then we sold out down here. Well, the signal was on the 19th. We sold on the 20th at the open, is how that worked out. So that was a losing trade. We didn't lose as much as we gained on the biggest winner, but of course.
Well, you're always going to have some losers, but I mean that certainly wasn't a catastrophic loss.
Right, it wasn't. And we don't have any stops in here either. We're just purely using the entry signals to get in and the exit signals to get out. And we could add stops in if you were interested in stops.
Sure, you could really refine it and experiment with the stops. I don't know if you want to do that or not, but everything is over there in the right window.
Yeah.
Where you can put your stops in.
Right over here, yeah. Well, we can look at... So we have a list here of all of the trades. These are all the individual trades. And there's various ways of grouping these. So you can group them by symbol or length of trade or exit reason. But you can also get a summary by using this chart here. And the statistical view shows you how that whole set of trades worked out in terms of percentage gain for each of the trades. And it's in this particular case, it's an interesting looking chart where you have quite a large clump of trades that were losers down here. But then on the winning side, it started to level out and extended up to the highest winner, which is the about 56%. There was one trade that made 56%, which is probably the EEM trade that we just looked at.
So by looking at the left-hand side of the vertical bar, you can see the negative, the trades that went negative, and you could possibly figure out where you want to place your stop losses generally.
Yeah.
To avoid that, the extremes anyway.
Right. It's a good way of trying to figure out where a good place for the stop would be. But as you know, as I often say, when you add a stop in, you often limit your profits as well, because you're not giving the trades that lost money temporarily during the trade, you're not giving them a chance to recover. So you have to be careful, and you don't want to set it too close to the 0% line, but you don't want it to be too far away that it exceeds your risk and reward ratio.
Now down on the bottom chart, you can see on the individual trades how far below the 0 line they went. So you can also get a feel there for how you could stay in a ETF without getting stopped out. I mean, it could go down and go up again.
Yes. Yeah, definitely. So if you look at the way to see that here is the green bars. The green ones are each one of these represents a single trade. So a green bar is a winning trade and a red bar is a losing trade. But if you look at the shadows of the candle or the wicks below this 0 line, you'll see how much they actually lost during the life of that trade. So yeah, if you'd have put a stop loss in that cut into that wick, those trades would have ended up being stopped out for a loss.
But it looks like if you put it most of them didn't get down much below 10%.
It seems that way. A good way to look at that is to go back up to this top area. You can see the minus 10% level here, and anything to the left of the minus 10% loss these are trades that did make it below and closed below minus 10, and there aren't that many of them, so maybe minus 10 would be a good place for a stop.